Okay, let's turn to what is happening in the markets today. We're joined by Michael Green. He's a chief investment strategist at Simplify Asset Management. It's good to have you. Thanks for taking the time.
It's a pleasure to be here. Thank you for having me.
So, are you noticing anything specifically in the U.S. markets today that you're watching for before we get into real specifics?
Well, I'm always watching for the behavior of quality stocks relative to what I refer to as junk stocks, companies that are highly sensitive to the need for refinancing, the need to tap capital markets. Those are really the primary source of weakness today, those lower quality stocks, combination of slightly weaker economic data than we might have expected, as well as a lot of questions around what is inflation going to be, how's that going to affect Fed policy, et cetera.
Okay, let's talk a little bit more about. I want to narrow in on oil specifically because oil is a bit down today. What are you seeing in terms of what's happening there?
Well, oil is actually something that I've highlighted as having become very, very cheap. It's an industrial commodity relative to, say, gold. And so the ratio between those two tends to have a much better predictive pattern than does looking at it versus simply dollars. Look, we're in a situation where the economy is clearly weakening. The industrial commodities are well supplied relative to the financial assets. We're getting to the point at which the ability to meet supply forecasts and supply projections is going to become impaired. You're seeing companies cutting back. ExxonMobil obviously it's a very small number cutting numbers. I heard you mention similar things are happening in Canada. The U.S. shale is now at a point at which rigs are falling, and we're seeing significant shutdown activity in terms of production. So we're ultimately looking at a situation where oil is going to end up being in short supply. It's just not yet.
You did note, though, that there was no one linear trend in oil demand. You said there was about a minimum of three. Can you explain what those are?
Sure. So a lot of people forecast the idea of total global demand. I think it's really important that you split that into the developed economies where oil demand is actually falling on a per capita basis with substitutes in the transportation market, in particular, beginning to emerge. The emerging markets ex-China is another another demand curve that I would emphasize. They benefit from the technological advancements of the developed markets, but as they gain in wealth, they are pushing higher. One of the primary issues that we're seeing is a relative lack of demand coming from the emerging markets and China. China is moving faster down the electrification of their transportation chain. The rest of the world is benefiting from China exporting cheap electric vehicles. And then the last thing, of course, is the growth has generally been disappointing in the emerging markets relative to what expectations would have been a couple of years ago. So those demand curves have really been the story so far. Now becomes the question of, does supply end up declining?
Okay, so supply and demand obviously are a huge factor here when we're talking about oil. What about the tariffs? Is that going to have any kind of effects, any kind of impact on the market moving forward?
Well, the biggest impact of tariffs is ultimately on global trade, right? And the reduction in global trade is hitting that demand side of the equation. There are some implications around the need to restructure components of the global transportation fuels supply chain, but that I would argue is taking a backseat to the economic developments. And certainly in the narrative, I think people are increasingly concerned about the potential for OPEC or others to expand supply. Candidly, I'm less concerned about that for the very simple reason that OPEC, like the United States, has suffered under low prices, and the reinvestment that's necessary to maintain production is really not there. And so I think we're basically biding our time, waiting for shortages in oil production to develop.
Okay, let's move on. I want to talk a little bit about gold because we're seeing gold reach like fresh highs once again. We haven't seen levels like this since I believe the 70s. What are you watching for here? What's going on?
Well, gold has absolutely been on fire, and it's really been on fire since roughly June of 2022, when the United States decided that it was going to confiscate the treasury reserves of Russia. That sent a flare out to China in particular, that they were not able to reinvest the proceeds from their tremendous trade surplus in the United States into treasuries. Instead, they began to reallocate it into gold. We've seen gold demand rise since. You can actually see the inflection point on that chart where the decision from China emerged. We're now seeing others follow along. And the only component that I would just emphasize is remember the general disdain that most of your viewers have for the actions of central banks. If you're pointing to central banks as the buyers that are driving your bullish thesis, I'm somewhat skeptical of that. I love holding gold. I think it is a fantastic asset to reflect the fact that you have uncertainty and lack of trust in central banks and national governments. The simple reality, though, is that story is very mainstream today, and we're seeing it in the flows.
Does it have, like, I take your point that there's some distrust with the government. Obviously, the U.S. dollar is always a reflection of how gold's doing as well. But is there any kind of supply versus demand issues with gold right now?
With gold, it's always going to be a secondary market, right? At the end of the day, production is a tiny fraction of what we're ultimately looking at. And so when you have a major buyer of US Treasuries, an entity like China, in which we're measuring numbers in the hundreds of billions that need to be reinvested, that is going to drive the secondary price of gold higher. It's really never going to be a story of we can find a gold asteroid or we can begin producing enough gold to create a meaningful supply hit. It's always about that secondary market.
And it's interesting what we're seeing right now. Like when we're looking at gold and reaching all these record highs, you look at the price of silver and the price of copper. They're not exactly doing the same thing.
Well, copper certainly is not, right? Copper falls into that industrial metal component. Silver has a bit of a monetary bid. It's kind of in between the two. In platinum, which has historically been a monetary metal, or at least referred into the same precious metal group, for a very, very long time, we actually had seen platinum use being dominated by its use in catalytic converters. That has been a source of net supply into that space. We're now seeing financial demand begin to offset it. So platinum has been extraordinarily strong alongside gold, while industrial metals like copper have suffered.
Okay, really interesting to get a breakdown of exactly what we're seeing today in the markets. That was Michael Green. Thank you so much for joining us. Appreciate your time.
Really pleasure to be here. Thank you.
Thanks. Once again, that's Michael Green, Chief Investment Strategist at Simplify Asset.